All right, welcome everyone. I'm Dave Spence, and this is the tax resolution deep dive with my friend Patrick Wanzer, CPA, CTRC. And we're going to be talking a little bit about divorce, debt, and deliverance.
Yep,
So, Patrick, why don't you tell us a little bit about yourself, and you can start with your side of the equation there, working with divorcees and others in tax problems.
sure. So my name is Patrick Wanzer. I am a CPA and a CTRC. I'm the founding member of Breakthrough Tax Resolution. Our firm specializes in does just IRS and state tax resolution work. That's basically all we do. And one area that we've built a lot of work in is dealing with taxes and divorce, and working with family law attorneys to deal with taxes and divorce. As a matter of fact, my second book that I released earlier this year, Break Free from the IRS, Taxes and Divorce, and Match Not Made in Heaven, available on Amazon.com, goes kind of a deep dive into all the different tax resolution options that are available in divorce. Now, some people ask, how did I kind of fall into that niche of dealing with tax issues and divorce? And it brings me to a client that I have of mine that came in and had their divorce decree with them, and was asking about an offer in compromise, which is a way to compromise a tax debt that you owe. You offer less than what you owe to the government. If they accept it, they kind of take that and wipe clean the debt. And their settlement agreement said that once they're divorced, a joint offer in compromise must be filed and accepted by the IRS within 6 months. There are two issues with that. Is first of all, once divorced, you can't file a joint offer, and the IRS never works that fast. And it was then that I realized that family law attorneys are always looking for people to work with them on how to discuss and deal with the tax issues in divorce. And so I've kind of built that niche for myself, working with the family law attorneys and doing a lot of presentations and training on how to deal with specific tax issues when it comes up in divorce. And so that's an area that we really gone into and really helped a lot of people with that.
Wow. All right. Interesting. So you had a regular accounting CPA tax prep type of service or job or business with a partner, I believe. Tell us how you made the transition and what it was like when you went through that.
Sure. So I basically I was with Edgewater CPA Group, and I've been doing tax resolution for about 10 years. But doing it alongside in the confines of a regular CPA firm where you do the typical tax season and that sort of thing, and have your business clients and all that stuff. But my specialty and my what I really enjoy doing is the tax resolution side of things and helping people resolve their tax issues. And so my uh, the owner of that firm and I decided to partner up and spin off our tax resolution division into its own entity, Breakthrough Tax Resolution, so that we could market it independently and kind of help people with their tax issues specifically. So we don't do a typical tax resolution. Doesn't do a typical tax season with tax returns. We don't do 400 or 500 tax returns for clients in a typical tax season. We do back tax returns, but we don't do with maintenance going forward. That's what our sister company Edgewater does. So basically, people have the tax problems. They come to us. We fix the problem, and we send them on over to Edgewater and they help keep them compliant going forward. So, but I got into it because it's challenging. It's a different profession in which to be. You have different cases all the time. It requires intellectual thought to solve the problems and help these people, and that's something that I really enjoy. So
Right now, that doesn't just happen overnight, I would think.
no, it definitely doesn't. And it took so when I was with Edgewater specifically, I was doing the resolution work for 3 years, and I had been doing it for years prior to that as well. But when I got my CTRC, I'm a trainer with Tax Rep LLC, and I've written two books on tax resolution. The first one is Break Free from the IRS, How to Resolve IRS Tax Debt and Reclaim Your Freedom. And it's just a book on different IRS tax resolution issues. And then, of course, the second one on taxes and divorce. But it didn't just happen overnight. Took a lot of time going to conferences, speaking at conferences, having booths there, getting to know people slowly but surely over time and building those relationships. And now when they have tax clients who have tax issues, they'll send them to me to say, hey, what can we do to resolve it? Maybe it's something as simple as do an installment agreement. Maybe they want me to testify in a divorce like I did 4 weeks ago. Maybe it's something where they need to deal with back tax returns or help writing settlement language specific to the tax resolution issue. So it's a great networking opportunity. There's a lot of potential work in the tax resolution area, working with family law attorneys. But no, it doesn't take it definitely didn't happen overnight, and it took a lot of time to build that. Or about a year into Breakthrough, and Breakthrough's doing great now, and it took some time to ramp that up.
So if we have people on this webinar trying to figure out, where they can go, I imagine they would probably, I mean, most CPAs would love to be able to do tax settlement work or tax IRS representation more and so forth. So would you say that a firm needs to be of a certain size so that you can expand, or can a one-man shop do this?
Well, definitely can. I'm just a Breakthrough is basically just a one-man shop. I mean, my partner Brooke, she owns Edgewater, and so she runs Edgewater. So basically, I am a one-man shop, and as you grow, you can get bigger. And there are tax resolution firms that do a little bit bigger work and are bigger size. And you have the national firms, of course, and they do a lot of on the national level. But you can be any size that you want. It's just something where it's important to learn the tricks of the trade when it comes to doing tax resolution work. I've been doing it for 10 years, and now that I do trainings and do webinars on it, I even coach a few people on tax resolution. It's a lot of it is kind of second nature to me because I've been doing it for so long. It's great to get the training, but it's also something to just kind of jump into and say, hey, why not do it? Why not go about it this path? I have a new book coming out next month called The Power of Why Not, Breaking Boundaries, Redefining Possibilities, that kind of talks specifically about the question, why not do it? Instead of why not? And that's why I think it's important that people can ask that question. And I ask that to myself, do I want to just take the easy route, or do I want to take the challenging cases? And that's what I did. But it could be a one-man shop. It could be a 4 or 5 person shop. It can be a bigger firm. It can be a part of a firm. But there's a lot of work out there to be done.
Yeah. And I think everybody's starting to look for why nots because they're fed up with the tax preparation, the compliance work, the deadlines, and all of that. So you said you don't have seasons, I guess that makes sense, but do you find that you're busy all year, and did it take a while to get there? And how would somebody who's listening, kind of approach that?
Well, it definitely is not seasonal in the sense of a tax season where you have a ton of work the first 4 months of the year, and then it could possibly taper off until you get to extension season and that sort of thing. I tell people that my busy season is January 1st through December 31st, because you have steady work all year long, but it's also steady cash flow because people are coming in, to do an analysis or back tax returns or whatever you need to do. And so the cash flow is steadier, the work is steadier. There's no specific time that's really more work intensive than other times. I guess maybe late summer it kind of tapers off a little bit. People are and summer vacations, getting back to school, they kind of taper off, and then some natural areas where they begin to ramp up. But overall, it's a pretty even flow throughout the year. Tax seasons are great because you can really ramp up your the tax returns you do, collect a lot of money, and then kind of live off of that for the rest of the year. Tax resolution kind of evens it out, and allows you to do that. One thing that's interesting, when I first started doing this, I had my own firm years ago, a different firm, and I was just a regular tax preparation firm. I had my first tax season, and I remember doing the first tax season, and I thought, man, this was great. I have this season. Wonderful. But when tax season ended, I thought, well, what am I going to do now? I had one bookkeeping client and I had no idea what to do. And I stumbled upon tax resolution. And that's really the genesis of how I started it is, I needed to have something. And so I looked at that, I read about it, I learned about it, and I realized it's something that can provide work throughout the whole year. If people are interested in getting into tax resolution, of course, they can always contact me. A colleague of mine and I are just about to release our book called Drop the P, How to Go from Tax Prep to Tax Rep. And it's a guide on exactly how to go from a tax preparation firm into a tax representation firm. And then we're going to do some master classes and some conferences to train people on that if they want to get into tax resolution work, either by adding it as a service or by transitioning to that in and of itself.
Oh, okay, that sounds really valuable. Um, One more thing, tell me about how you charge. And, there's a lot of talk about value pricing and things like that, getting away from hourly fees. But if you don't know how much time something like this is going to take, I imagine you're kind of stuck a little bit with fees that have to be on an hourly rate.
Well, when it comes to a lot of the resolution work, I do a flat fee on quite a few things. If we need to do a financial analysis to see if someone qualifies for an offer or is currently not collectible or a payment plan, we kind of got it down to a science on exactly here are the documents that I need from the client. Once they give me the documents, we can fill out the information, put it in our tax up software, and get the answer. So we do a lot of flat fees ourselves. When I do any type of litigation support, that is an hourly thing. So if I'm going to prepare to testify in a divorce or something, that's purely hourly because there's no way to really know what that's going to be. There's no way to know how long you're going to be on the stand if you are testifying and that sort of thing. But I know relationship pricing is a big push right now, and there's a lot to be said about that. Some people still like the old hourly pricing. If you do flat fee, you can have scope creep where the job is bigger than really what the engagement agreement says. We actually have a whole chapter in Drop the P on pricing and the different pluses and minuses of the different strategies. But personally, I do the flat fee billing because I just prefer not to have to track my hours for billing purposes if I can avoid it. So,
Okay. All right. And how about artificial intelligence? How's that work into where you're
well,
headed?
AI is great, especially when it comes to the marketing side. Um, but I don't. So I use it for marketing, for blogs, for if I'm going to do YouTube videos and things like that to help promote the firm. I use AI for a lot of that. A lot of people use AI to write their letters and maybe to tighten them up. I don't do it for that because when I am writing a cover letter to, I like to explain, step by step. Here's the process I want the IRS to understand and why we have that route. But a lot of people use AI for that to tighten things up. Use AI for for emails. I think it's a great benefit, but I think it's something that you just kind of have to, you know, make sure it's going to be in the realm of what you really need it to be.
Okay. All right. You find yourself doing tax planning with clients as well?
I personally don't do tax planning. I mean, we do if I have a client and they're coming in and we're talking about getting them an offer and compromise on what they need to do going forward, should they be an S corp and things like that. Yeah, we'll talk a little bit about that. But when it comes to tax planning to reduce their taxes, that is something we push over to Edgewater CPA Group. We do just the resolution side, basically, where we're kind of getting the clients out of the trouble that they're in and getting them kind of reset, and then go back over from the next opportunity. So
Good, good. Well, you know that I've spent a lot of my time in tax planning and financial
I
planning.
appreciated that.
Sorry.
So, let's see.
More?
You know what?
It's somebody to mute there. Okay. Yeah, I don't do any tax work, and I'm glad I don't have to do the tax resolution stuff. I think a lot of people would really enjoy moving in that direction, and I hope they'll take you up on your offer to chat with them and read some of your books. I want everybody to know that I have spent 40 years plus as a CPA and 35 years plus as a CFP. I left public accounting back in the I would say late 80s, mid 80s. And I had about 6 years of doing some audit work, some tax returns, some government audits and so forth. I live in the DC area, but I left that because I kind of fell in love with planning, financial planning specifically, but a lot of financial planning is tax planning.
Hmm.
And I recently put out a webinar, a free one that's on my taxfreetutors.com website. That's how to divorce the IRS. So
Hmm.
it's a totally different concept than what you have to deal with on a day-to-day basis. But I see that there's a lot of writing on the wall, and there's so much information that we have to be aware of, and so many deadlines and everything that we have to know and do and learn and all that stuff, that a lot of people are just not smelling the coffee, if you will. They're not paying
Right.
attention
Exactly.
to the fact that tax rates are historically low. Everybody thinks they're paying too much in taxes now. And if they look back at what they would have paid back in the 80s and 70s and 60s, in fact, between World War II, 1945 and 1985, anybody making, $50,000 would have paid more, adjusting for inflation and all that. They would have paid more in every one of those years at $50,000. At
Right.
$5 million, they would have paid much more at every one of those brackets. So every one of those years for a 40-year stretch, we were paying down the debt from World War II, and tax rates were high. And here we find ourselves in 2025 with the highest debt we've had since World War II.
Hmm.
So basically, in 1986, when we changed the tax code, it brought the rates way down, and they've been held down, and we've been printing money like crazy ever since. And that takes our debt to $38 trillion now. And the only way to pay it back is to raise taxes or cut costs. And now
Right.
we've got 11,000 baby boomers signing up for Social Security and Medicare every day, and they're saying, "Don't cut mine." Get
Exactly.
get it
Exactly.
somewhere
And
else.
that's one thing, we've talked about Roth IRAs and how you put money in post tax and earnings growth tax free. But that's at the whim of Congress at any point. Those things could change, and who knows what it's going to be in the future. So just those things to keep in mind, as we don't
Yeah.
know how the tax rates will affect us in the future.
Yeah, and everybody's upset with Congress, and they have every right to be. They just keep kicking the can down the road here on the debt, and they bicker over absolutely everything. If
Exactly.
if the leadership in one party says, "I don't like this idea," then nobody in that whole party can support that idea. It's crazy. They're just like foot soldiers following, the leaders of the pack and fighting the president, whoever happens to be in office.
Exactly.
So
Exactly.
so I've come up with the idea that Roth conversions are great, because if you do it now at a 22 and 24% tax bracket, even higher than that, you might be avoiding a 50 or 60% tax on those same dollars later on.
Hmm.
And we've got to kind of convince people that you're not going to be in a lower tax bracket in retirement. The bickering will go on. I see it lasting for another 6 or 8 years before they paint themselves in the corner and they are, on the verge of defaulting on our debt, and they'll have to do something. Now, there's not very many places, as I said, you can turn. So I'm trying to prepare people for higher tax rates in the future. And Roth is one idea. And when people can't do any more Roth, then the life insurance retirement plan is another one. And that's a monster there, because most people don't like life insurance. They don't like life insurance companies, but you have to just hate them a little bit less than you hate the IRS, I suppose.
True, true, true. I mean, that's very true. So tell me a little bit about LERPs, and what they entail and what they're all about.
Yeah, life insurance retirement plan, for the idea of setting it up as a retirement plan, not just as a life insurance benefit. So that kind of uh, tells us that we need to be talking to somebody that has enough money to save more. The first
Hmm.
places you ought to save are in Roth IRAs, Roth 401ks, and things like that. Even if you have to pay the taxes today, you're not going to be paying taxes on it later on. So
Hmm.
that's the first and easiest way for people to do it. But a lot of people hit the limits, or they're not eligible because they're over, their income's too high. And if they convert, they might be converting in a very high tax bracket, but they still have some cash they can use. Maybe they've got inheritances. Maybe they've just got a big taxable brokerage account that generates these big 1099s every year. So I'm telling them, take that money and move it into a life insurance policy where you get the smallest death benefit for the planned contribution. So you it's like a defined contribution plan. You say, I want to put in $20,000 a year. Now depending on your age and so forth, you go out and you find out what's the least amount of insurance I can get for that $20,000 a year contribution. And that's going to keep the cost down. And then you'll have tax-free money available to come out of it later on. Now,
Yep.
most people think that it's too expensive up front. And the reality is it is very expensive up front. But you're talking about over the life of the policy, just like your Roth IRA should last for your whole life. If you evaluate it on the whole life of the life insurance policy versus the Roth account or your tax deferred, 401k, it all should be evaluated on your lifetime. And if you factor in higher taxes later on, the Roth and the LERP are going to outperform that tax deferred account. And the LERP is actually going to catch up because its expenses are lower in the back end.
Mm-hmm.
Whereas if somebody's managing your money for 1%, it's going to be more expensive on the back end. And, you pay somebody to manage your money and try to keep it safe and grow it and all that stuff, diversify. So those fees are going to be there. And over the life of the contract, a LERP will probably run about 1.5%. And that's pretty close to a managed investment account. So,
Gotcha.
and the other thing is that upfront costs are usually what the tax professional might say, and the investment advisor who doesn't understand LERPs or life insurance or doesn't sell them, they're going to say that, we can do a lot better without paying those fees. But I'll tell you what about those fees, they have to be there. It's economics. And if you look at it over the life of the plan, then paying the front end charges and then lower charges later on allows it to be equally as good. And then you've got a death benefit that's going to be higher than what you take out of that Roth account or tax deferred account. And you can use it for long-term care if you're using the right product. So things like that make it pretty powerful. And I think that it's less attractive to Congress because there will never be anywhere near as much money in LERPs as there will be in Roths. And as you mentioned a couple minutes ago, if they go looking for places that they can tax, they're going to see those Roths are huge. And even if they just tax 5% of your Roth distributions or 10%, that's going to be real dollars. And they probably won't do that to the LERPs because here you're talking about a life and death contract between the insurance company and the family. And there's just not that much money that's going to be in it. So
do companies who sell LERPs, do they pay dividends that can then be used to reduce the premiums that people pay each month for the LERP?
Good question. There's three different types of contracts. Basically, permanent insurance has three different flavors. One is using whole life vehicles that may have dividends and so forth that help it to perform better down the road. Another one is variable universal life. And in a variable, what that's telling you is you can invest in the stock market through a bunch of mutual funds in there. And then the third one is an indexed UL, which is by far the most popular. With the index product, you're following an S&P 500 index or any number of other indexes that are being created. And the good thing about the IUL is compared to the variable can lose money when the markets are down. And the IUL caps your losses at zero. So in a bad market like 2008, when we had a 38% drop in the S&P 500, you would have lost a lot of money in the variable contract. You wouldn't have lost any money in the whole life, but you would have probably gotten your 4 or 5% growth. In the index product, you've got the upside of the 10 and 20% years, although it's probably going to be capped at, say, somewhere between 10 and 15%. So you avoid the downturns, but you start at the same spot after a downturn year. You start at zero again, or wherever you were the year before, and then you might get a 15% return because the market's going to rebound, 20 or 30. Sure. And some of the indexes are uncapped. So you could actually get a 30% return after a 0% loss. So there's a lot to understand. It's complex and you got to use an expert. I'm an expert, and there are probably 100 or 200 around the country, but that's a small number compared to people that can just sell life insurance.
Sure, sure. So that's an interesting way to go. How would that be used? Can it be used in divorce? I mean, if there are couples that are divorcing, is there a way that you can work with a family law attorney to talk about, you know, life insurance, retirement plans, or something to that effect? Or is that not an area you dive into?
Oh yeah. I mean, I'm dealing with people for the rest of their lives, and you have to take into any kind of, all the different possibilities into account. Um, in a when you set up a plan, if you're happily married, you might have a policy on each spouse, because they want to do the maximum that they can do, and they both probably want that death benefit available for long-term care. What happens is you have a $500,000 policy and you've got $200,000 in there. You can take the $500,000 or a chunk of it every year as a prepayment of your death benefit,
Sure,
and you use it for long-term care. So that's something you're not going to get out of other investments. And that's why I like to have it on both spouses. You could just put all of it into one, and whoever owns the contract, pulls the strings and makes the decisions. You can have a trust own it. You can have a corporation own it. You can have your spouse own it. You can own it yourself. So all of that stuff comes into the design stage of it all. And then in divorce, it's an asset that can be, moved back and forth, as required or as necessary. It might be the most attractive asset in some cases because it's never going to be taxed again.
sure, sure. What I find interesting is the importance then of developing relationships with the family law attorneys for what you do and what I do, because the family law attorneys play in the family law sandbox. And if you know a lot of family law attorneys, they don't like to be outside of the family law sandbox. They will adamantly say they hate tax, they hate investments and all that stuff, and they want to create those relationships with those other professionals so they can lean on them during divorce negotiations. And what you offer, what we offer, is just a perfect example of why it's important to go out and build those relationships with those other family law attorneys so you can provide the information that they need to properly uh, do the settlement agreement so the divorce can go through and both parties are protected.
Right. Absolutely. And I just, in fact, it's sometimes difficult for me to get tax professionals to be open-minded about the realities here, with the debt and with the tax rates and all of this stuff. If they start thinking a little bit long term, it doesn't mean you have to be a formal tax planner. You just have to be saying, okay, we're doing everything that I can see that we can do for you, Mr. Client, but I'm a little bit worried about the national debt and the taxes and the history of our tax system, and we've been here before and all that stuff. Let's start thinking long term, and we may need to do more Roth conversions and complement that with a LERP.
Sure,
Um,
sure.
yeah, and
And
a
what
lot of
I
people are going to end up with millions and millions of dollars in tax deferred assets. And
yes,
what happens when the highest tax rate goes from 37 to 70, like it was for all of the 1970s? The highest rate was 70%, and you didn't
sure,
have to be making $1 million for that. It's
sure,
kind of crazy. At every level, you would be paying more. So
sure. How do LERPs then figure into estate planning and something like that in succession planning? If somebody with passes away, do they transfer? How do they work in that area?
well, for now, we don't seem to have too much of a worry for the state taxes for many of our clients. But
Well, that's true.
and if you just want to create cash flow that's tax free, they're still going to make sense. But you have to own it, or your spouse has to own it, which adds another level of risk for divorces and so forth. But you can have
Sure,
what they call a SLAT, a spousal lifetime access trust, so that you can have a big policy on your life and you can be funding it. Your spouse can have access to it to make withdrawals for retirement. So you can have your cake and eat it too, because the money can pass outside of your estate because it's owned by the trust.
sure. Do LERPs have a cash value then? They just like a whole life, they have a cash value as well, correct?
Yes.
That builds.
Yes.
So that what's interesting is when it comes to dealing with tax issues in divorce, let's say you're dealing with an offer in compromise or something, a term life policy is an allowable expense on your income expense table, but a whole life policy or LERP is an asset. The cash value is an asset. So
Right.
it's another reason to make sure you are up to date and compliant, and that your tax situation is taken into account, because the cash value of that policy is an asset that the IRS can not necessarily seize, but if you were looking for some sort of resolution option, they'll consider that an asset that could be tapped in order to pay the tax.
Right. Right. Yeah, and that's and in a divorce, like I said, the well-funded LERP, 10 years down the road, it's going to probably have a little bit less cash than a Roth IRA might have had if you started them both at the same time. But if you go out in 15 or 20 years, the LERP's actually going to have more cash in it if they're both earning the same rate of return. So
Sure.
it's going to be, the longer you hold it and the worse the tax rates get, the better the asset looks.
Sure. How does Social Security figure into this? Because we all know that the Social Security trust fund is at some point supposedly will not run out of money. At some point, just benefits will have to be cut because they're only taking enough to pay out. But does that figure into the planning as well? Does this help kind of get away? Do you help work with clients, say, hey, look, let's kind of assume Social Security isn't really going to be there that much down the road, so let's plan ourselves so we don't have to rely on it.
Right, absolutely. And even now, if Social Security survives, 85% of it's going on your tax return, right?
Exactly.
And nothing from the LERP is going to go onto your tax return. So you could take a lot more money out of that, or a lot less money out of that, and still on an after-tax basis be in the same shape. So yeah, it's Social Security's in trouble. And let me tell you a lot of people don't realize this $38 trillion in debt, that's huge. And there's actually no way for us to pay it down without higher tax rates and cutting expenses. So when you have the Social Security, that's not even part of the debt.
Right.
We're the only of the top 35 nations in the world. We're the only one that doesn't carry unfunded liabilities on our balance sheet. So all the people that are living right now, and if they just live to normal life expectancy, we know what that's going to cost, and it's not in the budget. It's not in the debt balance. It's not
Right.
the liability, and it really should be. So we're probably talking about hundreds of trillions of dollars. And, Social Security is going to be at risk. Medicare is going to be at risk, and somebody's going to have to pay more for it. So,
That's true.
yeah,
That's true.
it's kind
So
of an ugly situation. I think it's plenty of real reality, I guess, that you need to start looking at it and start thinking hard about it.
yeah, that's a great point that you make, is that people are still relying on some of this stuff as if it's going to be there like it is today or like it always has been, and things will have to change at some point. It just, the numbers are the numbers, and at
Yeah,
some point it's either you take in more or you pay out less, or a combination of both, and wherever that comes from. So when
yeah.
dealing with,
The
go ahead,
math
I'm sorry.
isn't the math isn't mathing. Yeah,
Right. Absolutely. It's just not. And as we know, politicians like to kind of kick the can down the road because
right.
politically they want to, what can they do to make sure that they get reelected or something to that effect. And I get it. I get that, but there's also there will come a reckoning where it needs to be dealt with. Whether it's with the life insurance retirement plans, or how you're going to do your retirement planning, um, or if it's with just taxes and you have tax issues and have to even resolve those. Who knows, down the road will Congress do something that will make it harder for people to resolve their tax debts down the road? We don't know.
Right.
Congress could do away with the idea of an offer and compromise or something like that. Just who knows what's going to happen, and it's something to plan for now. And I think that's one of the overriding communication objectives, is to plan for it now, because you don't know what the future may hold.
Yeah, and that's the whole concept of divorcing the IRS. We're not going to avoid our legal tax obligations. We're just going to be smart enough to decide when to pay the tax. We
Right.
can we can pay it at today's rates and be done with it. And then whatever they do later on, it's fine because we're not going to have to pay taxes on it. So if the rates go to 60%, then the average rate goes to, 45%, the average, then, you've already paid your taxes at 22, 24, and so forth.
Sure. Sure.
I've got my own book out too. It's trailing you in the total numbers there, Patrick. But I wrote a book called the Tax Pros Guide to Using L.I.R.P.s for Advanced Tax Strategy Advanced Tax Planning. So it's the Tax Pros Guide to Using L.I.R.P.s for Advanced Tax Planning. It's going to be available in the link here. It's in the chat right now. Anybody that attends, we're going to send you a recording of this, and I'm going to send you an offer to get my book for free, the e-version of it. There's also a hardback version, and see if that works. Almost. Yeah. So, and I had David M. Walker, the former Controller General of the United States, he wrote an endorsement for my book. Ed Slott, who many know in the CPA world, an expert on retirement planning, he's endorsed the book, and several others. And I think it's a really good, easy read for tax professionals to say, okay, if I want to be thinking outside the box, I want to be a little bit more forward thinking. I want to take care of my best clients and the ones that have the extra money and they wish they could do something else with it. This is a good idea to get comfortable with L.I.R.P.s as one of the options. It shouldn't be the only thing, but it should certainly be on the table.
Well, and you just made a great point that it's one of the options because there are many options out there. And what you do is you really educate people well on how L.I.R.P.s are a great option. It's not that's the only option. You're not saying that it's this and nothing else. It's just another tool to add. And when you have somebody come to me, okay, that needs to deal with the tax issues, they get them dealt with. I can send them over to Dave. Now you do the tax planning. Okay, we got you resolved. Let's get you moving forward now and planning going forward. And that's the key. It's a long-term process. I think sometimes people come in and they want me to just wipe clean the debt tax day. You don't have to pay it, and it isn't how it works. And you're not saying that people aren't going to ever pay taxes. What we're talking about here is minimizing the amount and being strategic to reduce the amount that we legally have to pay to the best way we can.
Yeah, I agree 100%. I think that we have in the chat for everybody that's listening, go to the chat and you'll have the link to Patrick's book, at least one of them, and you'll have the link to contact him, and you'll have my contact information and the link to my book. So, Patrick, anything else we need to add here? Anything else we haven't covered?
No, just again, I think it's first of all, I appreciate the opportunity. Thank you so much for doing this with us. If people are interested in adding tax resolution to the practice or something to that effect, please reach out to me. We offer coaching services to help people kind of learn about that. We can get you a copy of our new book that'll come out next month, Drop the P, How to Go from Tax Prep to Tax Rep, and kind of point you in that direction. If you're interested in learning more about life insurance retirement plans, please reach out to Dave. I mean, he's the expert with the book that he wrote, and can really kind of point you in the right direction on where to go, either to help your clients or if you yourself want to learn more about it. Great opportunities, great resources to have.
All right. Well, thank you very much for that plug in for yours. I think that people can really make a major step forward and kind of reduce the stress of being a tax preparer.
Yes.
Nobody likes it. Everybody needs it. We got to find a better way so that it's a win-win situation.
Sure. Absolutely.
All right, Patrick, we'll talk again soon.
Okay, Dave. Thank you. Take care.
All right. Bye-bye.
Bye.